Sophie Jewry, and I am the Queen of Brandon. Today I am talking to Richard Proctor from Larking Gowen, who is one of their top tax bods. And Richard, over to you to introduce yourself to everybody.
Thank you, Sophie. Good morning, everyone. Yes, I'm a tax partner at Larking Gowen, so I head up our tax advisory group, a group of specialist people with lots of experience of a broad range of taxes, which we help our clients navigate through every day.
Marvellous. You live and breathe tax, don't you?
I'm afraid I do.
So, budget time, it's all happened, it's fairly fresh, but you have been immersed in all of the new budget changes for the last few days, I know. So, would you like to give us a little bit of a brief overview of your thoughts of what the budget is, what it means, etc., and then we can run through a few of the kind of main bits that we want to chat through. Okay,
yes, we'll do. I think there were some broad themes that we heard last week from the Chancellor. One was helping small business. So there were a number of relaxations of the tax code, particularly micro businesses, and we'll come on to some of those changes later on, I'm sure. So that was very helpful. Equally, he came down quite hard on global businesses. There was quite a lot of anti-avoidance around how global businesses structure their business to avoid or minimise their tax in the UK. So he's certainly looking to change that and ensure people pay a fair amount of tax. And I think the other thing was savings. He's done some innovative things in terms of savings around ISAs, perhaps to compensate for some of the changes that may be coming down the line for pensions.
Brilliant. Right, I'm going to go through a list because I think that's probably easiest.
Okay.
So very, very briefly mentioning it, because I have talked about it before, but the new individual's income. So if you're working and you then decide to add a little bit of extra income, whether that be through renting a property or selling on eBay or doing anything else, you can now earn up to £1,000 profit, can't you?
That's right. Yes, there's a new allowance coming in, £1,000 for trading profits and £1,000 for rental income. As you rightly say, I think it's designed for those sort of casual transactions almost, but potentially online. So if you're selling stuff on eBay, in theory, if you make a profit, you've got a taxable source of income. You should be making a self-assessment tax return. You should be paying some tax. And what HMRC is saying, sensibly in my view, is that if you do that sort of thing and you only earn £1,000 or less a year, then don't bother to report it and we won't tax you on it. And that's the same for renting out your drive for a couple of weeks. If you happen to live near Wimbledon, for example, then again, we'll overlook that £1,000 of income. So I think that's a very useful relaxation for all of us.
Yeah, and that's profit, isn't it? So if you sell 5,000 and you only make 1,000 profit, then you still don't have to fill in the self-assessment tax, a tax return form for that.
That's how we understand it at the moment. Yes, we haven't seen the detail yet.
Sounds good. So in terms of help for the small businesses, we've got rate changes. Do you want to have a chat through some of those?
Yes, business rates. There's always been a relief for smaller businesses where they incur business rates. So if they've got a smaller premises, there has been a small business rate relief. They're increasing it, essentially. So they're saying that where businesses have a rateable value of property up to £15,000, then they'll be able to claim this relief. Previously, it was £6,000, so it's quite a significant change. And it's
quite a big jump.
Well worth looking to see whether you qualify for that relief, because that could make a big difference to your business.
And that is that's based on old rental figures, isn't it? It's quite a strange one.
Yes, it's still on the old rateable values. I mean, one of the things that businesses have been calling for some time is a review of the whole rating system, because it is rather outdated now in terms of it's based on very old valuations of premises. So the government have, for whatever reason, shied away from going through a revaluation exercise, which would clearly be quite unpopular. But I think now there is calls for saying that the current system is not fit for purpose, and there does need to be a reform of some kind.
But it is obviously so. For the rates side of things, obviously that would all come in when you're looking to rent a property, but it's worth obviously investigating, because it might make your choice of property change based on the fact that you get the small business relief.
It could do, or if you own a property, of that size, then obviously business rates is a factor. So well worth looking to see whether you now can claim some relief.
Class 2 national insurance?
Yeah, Class 2 national insurance is paid by the self-employed. So self-employed pay Class 2 and Class 4. Employed pay Class 1, and Class 3 is voluntary. So Class 2 has been a bit of an anachronism as well, in that years ago it was an old stamp that people bought and put on a card and then submitted at the end of the year. We've been paying it monthly, most of us, through direct debit for a number of years now. They've now changed that to say that we don't want it monthly, we'll collect it through self-assessment. The Chancellor said last week we're actually going to abolish Class 2 from 2018. The reason for the delay, I think, is that they do need to look at how they reform national insurance for the self-employed, because at the moment Class 2 does entitle self-employed to certain benefits, and therefore they will need to replace it with something, maybe an enhanced Class 4 contribution is on its way, but we'll wait to see on that.
And that is, it's actually only £150 or something, isn't it, in total? But that doesn't come in, though, until, although they've stopped collecting it now, haven't they, in the monthly thing, but it doesn't actually come into being stopped completely till 2018.
That's right. We're still paying approximately £12 a month, but under self-assessment now rather than on a monthly direct debit.
Now, I didn't ask you this when we were just having our pre-call check, but the tax relief for travel and subsistence.
Yes.
I noticed that, obviously, there are some people who won't be able to claim travel expenses or lunch allowance. And it mentioned the IR35 rule,
yes.
But that if some people who are under that, they can still claim it. What kind of an impact would that have as an employer?
This is an anti-avoidance measure, really. HMRC, there've always been rules around travel and subsistence. For example, the key rule is that you can't claim a tax-deductible expense for home-to-work travel. They call it ordinary commuting, HMRC. So you've never been able to claim that. This is an anti-avoidance measure because certain companies or employment agencies have set up umbrella companies. So, we could all be employed by that company and then we work for the NHS or we work for a big organisation. And because of the way they set up the contract, you're able to claim tax-deductible expenses for home-to-work travel and subsistence such as lunch. So this is targeted at those particular companies because there has been a case called the Reed employment case where the employer was unsuccessful, actually. HMRC successfully challenged their arrangements. But there are a lot of others out there, and they really just want to stop it because they believe it's abusive. Okay,
so for your average small business, that's not really going to be hugely relevant because we can't claim it anyway. I know a lot of self-employed and business-related people kind of think that everything goes on expenses, and when you go and you splash the cash in the restaurant and you get champagne and lunches and everything, it's all tax deductible, but actually none of it is tax deductible.
I'm afraid entertaining is another one of those costs which isn't tax deductible.
I know when I came self-employed, I was like, yes, I can totally, all my restaurant foods, I can now claim it again, and then thinking, oh no, I totally can't.
It's more aimed at employees than self-employed, but
yeah, so that's fine. So that's kind of covered on that one. Okay, so going through these, let's have a quick scoot. Although I appreciate I'm skipping around a little bit here, but I will go back. So looking at the pensions and lifetime savings, the new ISA that's coming in, that's quite a good thing, I think.
Yes, well, it shows some creative thinking and some innovation, I think. I think this is something of a fallback to the pension debate that was going on before the budget. You may recall that a month before the budget, there was rumours around would tax relief on pension contributions be stopped? Would the tax-free lump sum be stopped? That was encouraging people to take action on their pensions driven by the tax rules rather than what might have been sensible from a retirement planning point of view. So 2 weeks before the budget, very unusually, they actually announced we're not going to change any rules for pensions, so essentially don't panic. But interestingly, he did introduce in his budget speech the lifetime individual savings account, the lifetime ISA, which essentially is designed for under 40s. If you're under 40 at April 17, you'll be able to save £4,000 in the lifetime ISA per year. And if you do that, the government will put in an additional £1,000. In order to keep that government bonus, you've either got to use the money to buy your first home or keep it until 60, and then supplement your retirement income. So it's very targeted at the young, and it's targeted at helping them either buy their first home or help them in their retirement.
Yes, because obviously that's one of the big scary things, isn't it, that the government's worried about at the moment, is the fact that nobody's saving like they used to. And then we're obviously going to have this mass amount of people who are needing lots of money, and there's not going to be enough in the pot.
It's the demographic time bomb, I think.
Yes. Yeah, so I mean, it sounds good to me. Plus, it's relevant for me as well, so that's always a bonus. Damn it. So, okay, we covered that one. And obviously the ISA amount has gone up as well, quite a substantial.
That is true. The normal ISA limit is currently 15,240, and it will stay 15,240 for 16-17, but from the 6th of April 17, that is going up to £20,000. So, yeah, a significant increase in the limit there for ordinary savers.
Nice big jump. Now, I've obviously done another interview. We talked about the budget with Emma Stevens, and what we covered briefly, but I thought it might be worth mentioning now, while we're on the subject of pensions and things, is the auto-enrolment, because obviously people who are listening to this will then be here listening to it. So it's something that a lot of people don't realise is compulsory to set up, isn't
absolutely.
it?
All employers are under an obligation to auto-enroll their employees. It's being phased in over a 3-year period, depending on the size of the business. So most larger businesses, their staging date, as it's known, has already passed, and they should have, set up a pension scheme and automatically enrolled all their employees. That's the point. The default is you're in. You have to opt out as an individual if you don't want to be part of the employer pension scheme going forward. I think you have 3 months to opt out. So if you don't opt out, you're then in it. I think every 3 years you'll be auto-enrolled again, even if you do opt out. So clearly the emphasis here is the government want people to be part of an employee-sponsored pension arrangement, and they're almost forcing your hand. In fact, you've got to do quite a lot to avoid being part of an employee pension scheme going forward.
And of course, that applies if you are a one-man band limited company, you are an employee, so you have to set up your own pension. It's not a matter of having a conversation and going, oh no, actually I'm not interested in that. You've just got to do it anyway, and then cancel it.
Yeah, I think there might be an exemption if you're a director. So if you've only, if it is literally a one-man company with one director, you may be okay. But any more than that, any other employees, then yes, the auto-enrollment provisions will apply.
And of course, it's an act now thing, isn't it? Because that's all been happening for a little while, and people have been putting their head in the sand and not necessarily dealing
and smaller and smaller companies are now getting caught in that net, because the staging date for smaller businesses are now rapidly approaching if they haven't already passed.
Yeah, okay, super. So that's obviously, I just briefly thought I'd mention that one. So where are we up to now? We've talked about rates, but what we haven't talked about is capital gains tax rates, because that's quite a big change.
Yes. Currently, in this current tax year, if you're a higher rate taxpayer and you make a capital gain, you sell stocks and shares, or you sell a property, you'll pay capital gains tax at 28% if your gain is more than the annual exemption, which is currently 11,100. If you're a basic rate taxpayer, you'll currently pay 18% rather than 28%. From the 6th of April, the Chancellor announced that those rates are coming down to 20% for a higher rate taxpayer and 10% for a basic rate taxpayer. So that's quite a big change. There is a sting in the tail, though. Those reductions in rates won't apply if you make a capital gain on the sale of a residential property. So if it's a second home or a holiday home, or you invest in residential property as a landlord, and you then sell one of your properties and make a capital gain, you will still pay 28 or 18, depending on your income tax rate position.
Yeah, in fact, there's quite a few things to mention when it comes to landlords, isn't there? Because we've got, I'm just trying to find the other bits here that we've got, because we've got the stamp duty change.
Yes, landlords seem to be targeted by this government over the last couple of years. There's the 3% stamp duty land tax supplement, which is coming in from the 1st of April. So that's something that will
Yeah.
catch a few people out, I suspect. It's not the 5th of April or the 6th of April, it's the 1st of April. Essentially, if you're buying a second home, if you're unable to certify to your solicitor when you're buying a house that it's going to be your residence and that you only own one property, you will pay this 3% supplement on top of the normal stamp duty land tax. So that is coming in from the 1st of April. And indeed, a lot of my lawyer friends are saying that they're actually stacked out at the moment doing conveyances for second homes and buy-to-lets because people don't want to pay this 3% charge. But once we pass the 1st of April, I'm afraid there won't be any choice.
Yeah, so they've got the 28% residential second home thing happening instead of the 20%. They've got the 3% stamp duty and also the wear and tear allowance.
Yes, previously landlords who let their properties furnished could claim a 10% of their rent as a deduction every year to allow them a tax relief for the cost of wear and tear. That's been abolished and it's been replaced with a replacement system. So essentially, when you kit out a house, so if you buy kitchen units and fridges and ovens and freezers, etc., you won't be able to claim any tax relief on the first purchase. But if you have to replace one of those items because it's broken or it's no longer of the right image, then you can claim tax relief for the replacement. So it will be on a full replacement system going forward.
They seem to be, for some reason, in an environment where people can't get mortgages and there's more people trying to rent than there is properties available. It seems bonkers that they're then trying to stop people from renting places.
Well, further, there is one other problem for landlords going forward is the restriction on interest relief. So if you're a portfolio holder and you've got loans against those properties, residential properties, at the moment you're able to claim a tax deduction for the full cost of the interest. From April 17, that is going to be reduced over a 4-year period until you can only claim a 20% credit for all your interest paid. So that if you're a highly leveraged property letting business, that will significantly increase your tax liability over the next 4 years, unfortunately.
Which will be a lot of people because everyone jumped on the bandwagon, didn't they, and started hurling investments out there and buying lots of properties off mortgaged up. So it's going to have a big impact.
Well, I think low interest rates, which we've been in that environment for 7 or 8 years now, has encouraged that because you can't get a decent return on cash or other investments, and you can borrow relatively cheaply. So people have been investing in residential property.
It's my phone ringing. I thought I'd turn that on to airplane. Sorry about that. So that sounds all like a bit of a disaster for the landlord, not very nice for them. So there's lots of nice positive things for small business people, but not very nice things happening for the landlords, which again comes into that whole big business thing, isn't it? Trying to tax the people who are earning the big money, although they're probably potentially not, which is not brilliant. So what have we got from so we've done capital gains tax, entrepreneurs relief.
Which is a capital gains tax relief. So this is where businessmen will sell a business and claim 10% capital gains tax rate, because if they're higher rate payers, they will currently pay 28 and will even pay 20 in the next tax year. So 10% is a very good rate historically. At the moment, that relief applies to businessmen who work in the business, so they're employees or directors, and they own at least 5% of the share capital if it's a company, or they have a 5% interest if it's a partnership. They've tweaked a few things around detail, but the really interesting development is that they've decided to extend this relief to outside investors. So if you're an investor who's looking to invest in a private company, but you're not an employee and you won't have 5% of the issued share capital, but you're putting in significant money to help the business grow, then you will be encouraged to do that by having this 10% tax rate if at the end, when you sell out, you make a significant capital gain. So I think that's an interesting one. It encourages investment and funding of smaller businesses potentially.
Which will be interesting, especially as we go forward with the whole Euro debate as to whether we're in or out and all of that sort of stuff. So what about corporations?
Yes, this was a bit of a surprise. The current rate is 20%, regardless of the size of the business. We used to have 2 rates. We no longer have 2 rates. So every company in the country pays 20% corporation tax at the moment. That was due to come down to 19% in April 17 and 18% in 2020. He now said there won't be an 18% rate in 2020, it'll be 17%. So we're going down from 20 to 19 next year to 17% in 2020. 20%, our current rate, is already the lowest of the G20 economies. So he is really putting it out there that the UK is a good place to do business, if you're a multinational, provided you play by our rules. I think that's the message.
And then we've got corporation tax losses.
Yes, this is aimed potentially at smaller businesses. At the moment, if you've got a trading loss that you incurred perhaps 2 or 3 years ago, you're now turning into profit again. You've turned the business around. Things are looking better. You, at the moment, can only offset that loss that you're bringing forward against profits of the same trade. And there have been a number of court cases, actually, where HMRC have challenged the offset of losses, where they believe the trade may have changed, or you're trying to set it off against other income, rental income or interest. What they seem to be saying, we haven't seen the detail yet of these provisions, is that they're going to liberate that whole regime. And if you've got a loss brought forward, you'll be able to offset it against any source of income, whether it's rental income or a different trade. So that will be a major change for the tax system, but it will assist small businesses get the benefit of their losses earlier.
Yeah, especially because a lot of businesses, you do have losses in the first few years, don't you, as you start trading, and often they get lost.
Yes, so, absolutely, and this will help to avoid that.
That sounds like a really positive one. And then we've got directors' loans.
Yes, these are loans to directors who are shareholders. Again, it's particularly a tax that affects smaller businesses and smaller companies. Companies that are usually owned by 5 or fewer shareholders are impacted by this tax. This is a tax where a company loans money to a shareholder and the company pays the tax. It pays 25% at the moment. That's going up to 32.5% from the 6th of April this year. That tax is repayable to the company if the loan is repaid by the shareholder to the company. So it's a sort of timing issue, but it can become permanent, clearly, if the loan is never repaid. What I think he's done here is he's aligned that 32.5% with the higher rate on dividends, because you may recall last year there was a big announcement around the taxation of dividends, the rates going up by 7.5% for all the different bands, but it's only coming in from the 6th of April this year, so we're only starting to see that impact now. And all he's doing really is aligning the dividend rate with the loan to participator rate, as it's known.
Is that because sometimes people will take payment from the company as a dividend and a loan as a way to save on tax, but that's going to try and stop that?
Yeah, it's another anti-avoidance measure, really. If you pay a dividend out of your own company, then you will pay income tax at the higher rates, depending on the amount. And so some people used to think, well, I'll lend it to the shareholder rather than pay it as a dividend and avoid the tax. HMRC have thought of that, and they'll tax the company, and they'll also tax the individual if there's no interest being paid on the loan.
Right, so that is going to nip that one in the bud, isn't it, for for that one? So what else have we got here? So many things to discuss. We've done the wear and tear. Very, very briefly, rent-a-room relief. That's actually gone up quite a lot, hasn't it?
It has. It's again a relaxation, really, in that for many years now, people have been able to rent a room in their own residence and claim a tax-free income of $4,250. So that's been very useful. They're now saying that will go up to $7,500 with effect from April this year. So that's a significant increase. So again, I suppose encouraging people to, if they have got spare rooms in their house, encouraging them to rent them out and get some tax-free income.
Yeah, so you've got, actually, if you are, looking for some extra income, you can do the $7,500 from this and not put in a tax return. And you can also get the £1,000 profit from other things and not put in a tax return. So you've got the potential to earn an extra £8,500 without having to do any self-assessment or anything.
Yeah.
Which is nice. Which is a good one. I'm sure that will help lots and lots of people. So let's skip on to the SDLT, right, which you can tell me what it stands for, on commercial property.
This is stamp duty land tax. So it's rather like we mentioned SDLT in the context of second homes and the 3% surcharge which is coming in. He also announced last week that he was reforming the SDLT for commercial property. So this isn't houses this time, this is factories, warehouses, offices. This was on an old system known as the slab system, where if you went over the limit, the threshold, you paid the rate of tax, the highest rate of tax on the whole price. So it could make a big difference whether you pay 249,000 or 251,000. It would change the whole rate of tax that you pay. He's now introducing what he called a slice system or a banding system, where you only pay a percentage on each band as it progresses up. So, for example, the new bands are 0% for 150,000 or below. So if you're buying an office for 150 or less, you won't pay any SDLT. If it's between 150 and 250,000, you'll pay 2%, but only on that band, only on that 100,000 from 150.
Okay.
And if it's over 250, you'll pay 5% on any excess over 250. So it'll be a different mix of percentages that you pay in the end.
Oh, okay. So that makes sense. So that's a positive?
Yeah, it's a fairer system, I think most people would say, because you then don't have that cliff edge effect of, if you go slightly over, you'll pay a lot of tax. It will be a gradual, progressive tax.
Mm-hmm. It also is about the 2% rate, but that obviously doesn't apply unless you've got a property that's over 5 million.
Yes, that's for leasehold properties. So, yes, he's increasing the SDLT on the grant of a lease on, as you say, properties over £5 million.
Now, I've got two ladies to hear, or at least one lady who's up in Scotland, and so actually that says it doesn't apply.
SDLT doesn't apply in Scotland, no. They have their own equivalent tax, which is very similar, but yes, is different and could, of course, be different going forward, depending on what the Scottish Parliament decides.
Oh, it's all fun and games, all this tax. I think we're fairly well there, but I did want to mention the making tax digital, which is going to be actually huge for a lot of people.
Yes, this is a bit of a revolution, really, in that it was announced a couple of years ago, but it's still being developed clearly. But yes, the end of the annual tax return is an interesting prospect for all of us, in that the idea is we'll all have a digital tax account going forward, and a lot of our income will automatically be imported into that digital tax account. So, dividends, interest from banks, our salaries if we're employed, will all go directly into the digital tax account with HMRC. If you're self-employed, and this is a significant change, you are going to be asked to report your business profits or losses on a quarterly basis. So almost real-time reporting, a bit like VAT. You'll need to report your numbers on a quarterly basis, and HMRC will then assess your tax liability on, rather than using estimated numbers, which we do at the moment, they'll use real numbers, and you'll be paying the real amount, proper amount of tax earlier in the business cycle.
It says that you have a choice potentially to do a pay and go. So do you think it will come in that although you're doing it, so potentially to start with, you'll be doing it quarterly, but you'll still pay annually with the kind of split two payments? Or do you think it will literally be that you'll then get that bill and you'll then be able to set up like for example, I tend to pay a standing order straight through, because I know then that it's covered, rather than having a big chunk to pay at the end.
Well,
it will be.
That's one of the benefits HMRC is suggesting, especially small businesses will see, is that yes, you'll be able to manage your tax liabilities better. You'll be able to spread them over a longer period, rather than having two chunky payments to make in January and July, as the current system is. So yeah, they're saying it's going to help. Some cynics are saying it's a way of getting tax in earlier.
Yeah, well, it's one of those things, isn't it? It will encourage people to keep their tax on top of things, because people tend, there's a lot of people that get very behind on these things, isn't there? I know I'm never as organised as I am when it comes around to VAT payment time. You've got to get that through. So I can see the benefits from that as well, but that's not until 2018, and we don't know dates of when that might be coming into effect or anything.
We
like that
don't.
yet.
It will depend on. I mean, I think HMRC are having quite a lot of conversations with software providers, because we've all got to have a system which will talk to HMRC's IT platforms. So there's a lot of work to be done behind the scenes to make this all happen. So I think 2018 is quite ambitious.
Yeah, because the real-time PAYE stuff has been quite interesting.
Yes.
from from various accounting friends who have said, yeah, it's been a bit of a nightmare to start with, but it seems to be that's settled down.
That's
now,
true, and that was the same exercise. There was a lot of PAYE payroll software providers who had to adapt their systems and make sure they could collaborate with the HMRC website. So yes, that has worked well, but you're right, there were teething problems at the beginning.
And of course, we've kind of covered most things there. I did notice, because I've got your Larkin Gowen budget report that came through, and it did say on there that generally speaking, it seems that the government are making it much more difficult for a small business owner to be able to do their own tax returns and deal with their own tax stuff. It's just becoming massively complicated.
Yes, one thing this Chancellor has done, I mean, he in some ways he wants to encourage savers, and he's introduced the £1,000 savings allowance from April, which will help, and people will get their interest gross now rather than having tax deducted at source, which again will help savers. But it is making the system more complicated. So the personal tax, the number of rates now of personal tax and capital gains tax, given the change, are multiplying every year, and that won't help people who want to do their own self-assessment and file their own tax returns, unfortunately.
Yeah. And that also then would apply to people who are retired, who are gaining a pension of bits and pieces, because you still have to do a tax return then for a lot of people.
Yes, indeed. Pensions are taxable unless it's a tax-free lump sum. So yes, if you're drawing a regular pension and you've got other investment income and you're over the personal allowance, then you will usually need to submit a tax return. And as I say, it is becoming more complicated to work out your own tax. You can submit the return earlier and allow HMRC to calculate the tax, but then of course it's nice to check that they've got it right.
Yes, absolutely. I did have a question. It's not really on the budget, but I thought I might ask it. It's kind of outside of your remit, really, in the sense that they were saying that it's a big problem for small businesses to get paid by big companies sometimes, especially government-based things. So instead of, I was just thinking if you've got any tips that you would suggest for small business owners if they are in a position where they've got an opportunity to work for a large corporate and they're looking at payment in terms of cash flow, the whole thing of getting the cash in rather than waiting 3 months to be paid. Is there any tips that you would have for them to do before they enter into that contract?
You're absolutely right. That's the time to think about it. It's not helpful to sign up to their standard terms and conditions and then realise that you've got a cash flow problem because you're not getting your money for 60 days or 90 days. Unfortunately, if it's a big business, they do tend to have the balance of power. Supermarkets are a classic example. They can impose their terms and conditions on most suppliers, unfortunately. There are pressure groups out there, and I know, the government have looked at this on a number of occasions, and, they've asked big business to disclose in their annual reports what their average payment time is to try and sort of shame them almost to doing the right thing. But there isn't any legislation, and I think it would be quite hard to legislate for that. So I think you're absolutely right. When you're first talking to about a contract with a big potential customer, it's good to get on the table early on and see whether you can get a sensible payment date for your particular business. Don't just accept their standard terms if you can avoid it.
Yeah, because I know people that do both. I know people that work for big corporates and even the same company, and they seem to get paid in a couple of weeks, and then other people are waiting 90 days, and I think it must come into those initial agreements.
Absolutely. Yes.
Yeah, thank you for that. That was a bit of a curveball, that one, but I thought I would ask it. Do you think is there any other announcement that we haven't said that might be worth a mention for small business, micro business, small business, or even big business individuals who are, making an income?
I think we covered most things, Sophie. I think I'll come on immediately. I mean, the personal allowance is going up from from April 17. That's the amount of income one can earn tax-free. That's going up to 11,500 from the 6th of April 17. So that this government has got an objective of getting that to 12,500 by the end of this Parliament. So they look as if they're on course to achieve that, which is good news. That takes some people out of tax altogether.
Yeah, because we're going up about £500. Because what we 10,500 to the end of this, and then it goes up to 11 for the next tax year, and then it'll be up to the 11.
It seems to be going up in £500 stages at the moment. He also announced last week that the threshold for higher rate taxpayers, so the level at which you start to pay 40% income tax, is going up to 45,000 from April 17. Yeah. Again, that's a decent increase, because at the moment it's 42,385, I think. So.
Yeah, it's 3,500 or something.
It's quite a good increase, that. So that will again reduce the number of people who are having to pay higher rate tax.
Yeah, which would be great. We like that. Brilliant. I think we've kind of covered everything, or at least most things. And of course, if anybody's got any questions, I'm not the person to ask. You're the person to ask. So how can they get in touch with you and ask?
Thank you, Sophie. Yes, well, as I say, I'm a partner at Larking Gowen, but there is a team of us, so it's not just me. But yes, please contact me if you have any tax queries. My email address is richard.proctor@larkinggowen.uk, and my number is 01603 723 648.
Marvellous. And obviously they can go on the Larking Gowen website as well, can't they? Which is larking-gowen.co.uk to find out anything to do with accounts and tax and
indeed. And our budget summary is on the website as well.
Yeah, which is worth a download because it's quite comprehensive. It's very comprehensive. It's what we've been checking through to discuss today, which is always brilliant. Okay. So thank you ever so much for chatting through that to me. It's just really handy to speak to somebody who obviously knows and has been working through it and having to deal with all of these questions regularly. So it's really good. So yeah, obviously I'm going to stop the recording in a moment, and then everybody can do that. So if anybody's got any questions, to obviously get in touch with you after listening to this. So thank you very much.
Thank you, Sophie.